It's not that they're buyers so much as that they're going to be printers. We know that every time there's a hiccup and gut pain, they come in and they print, they expand the money supply, they lower interest rates beyond reality, and they create monetary stimulus and therefore further sharp degradation in the money unit you use to measure your assets. So the gold price will continue to move inversely to the degradation in the money units. And we see these other factors we've been talking about, like a bond market in jeopardy, government bonds in particular, not mortgages this time, and the stock market bubble, especially here, as being factors that will spark a central bank into panic mode. Now, remember, even if Powell tries to stay tough, and he's going to find it very tough to stay the way he is between now and when he leaves in January. Because a lot of shit's going to happen between now and then. It's going to force his hand. Otherwise, the public will be marching outside the Federal Reserve building. Gold knows that. Gold knows what central banks do, and that's why it lives. So if we have another downside in these other assets, your guest, your subscriber mentioned, that will further impact the central bank into doing exactly what benefits gold, namely degrade the money unit rapidly. So that's why if you go back and look at the 70s or look at these bear markets that occurred in the stock market, gold went up during those times. There's like a few exceptions of a month here and there where it went down with the stocks. But generally, it goes opposite to the stock market in bear trends. Why? Because the central bank is going berserk during that time. This time even more so. We'll have to. So I think gold knows that. So I think the drop in those categories is bullish for gold.
Okay. All right. So they're buying real money, gold, and they're printing currency. Dollars.
Yeah. No, I don't care whether they're buying it or not. I mean, somebody's buying it, whether it's the Chinese or somebody else, or finally the Western public starts to buy it, which I understand is increasing too. But the reality will force the buying, and I don't care if it's central banks or not. They don't control markets, frankly. If they did, we wouldn't have boom-bust cycles. An investment public, which is getting more shaky about the stock market, and asset managers who've got their heads screwed on right, are looking at places to be within the stock market that are not performing in an uncertain way. And I think gold miners have slapped them in the face recently, because gold miners have suddenly grown a backbone, which we expected. Yes, I think miners are a better place to be than gold. I think they could double or triple the performance in gold over the next year or two, which whatever gold does, triple that on a percent basis for miners. Yeah. There's technical reasons for that. And I think silver could outpace them both, big time, on a percentage basis. In fact, I think this move in silver right now, you paused here at 37, which of course has taken out a bunch of highs. Yeah, you can see the distribution highs up there at 35, 35, 35.
Yeah.
You don't ultimately top that way. You might pause there, but you don't top. You generally spike when you make a major high. You go back to the 2011 high. It was gaseous.
People keep asking me whether we're about to see the big unwind, the catastrophic moment everyone secretly fears but tries to laugh off at cocktail parties. And I'll tell you right now, in my mind, we're already living in the slow motion train wreck. It's just that most folks are staring at the wrong set of signals. Let me start by saying, gold knows. Gold always knows. It's lived through every kind of monetary folly humanity has ever tried to concoct. From Roman emperors clipping coins all the way to the modern clown show of zero interest rates, QE, and now record deficit spending. Gold is like that grizzled old veteran sitting in the corner of the bar who's seen it all and quietly tells you, "Son, you better buckle up." What people often miss is that the gold price isn't just a measure of gold's value. It's the mirror reflecting the steady, relentless rot in your money unit. Because what gold's really pricing is the degradation of the dollar, or the euro, or the yen. Take your pick. The currency you measure your so-called wealth in is losing purchasing power by the day, even if the politicians and central bankers slap on their best stage smiles and try to convince you otherwise. Meanwhile, gold simply does what it's always done. It moves inversely to the decline of these money units. That's why every time the system gets a gut pain, the central banks come running with the same tired remedy. They print. They slash rates. They fire up the QE machine. And they hand out liquidity like candy at Halloween. And each time they do it, they pile on a little more rot. The dollar's value decays further. Your bonds yield less in real terms, and gold quietly recalibrates to reflect the damage. You know what else? The big markets know it too. Just look at what's been happening in the bond market. That's the deepest, supposedly most risk-free asset pool on Earth. But the long end of the Treasury curve is sending up flares so bright they should be waking up the entire financial world. You've had the 10 and 30-year yields refusing to come down, despite massive attempts by the Fed and Treasury to coax them lower. Every time we get a little rally in bonds, say in January, February, or even early March this year, it's snuffed out in days. Back in April, we shot from 114 on the long bond futures up to 121 in the blink of an eye. And then, boom. 2.5 days later, we crashed back to 111. That's not a market functioning on normal demand and supply. That's a market lurching from crisis to crisis. What's driving that? It's decades of compounded policy error. Not just under Biden or Trump. Go back to Bush, to Obama, even to Reagan if you like. Each cycle kicked the can further, relying on ever lower rates, ever expanding debt. We were told it was sustainable because this time is different. Newsflash, it's never different. When the bill finally comes due, it's usually with interest. Now, let's talk about why this is so bullish for gold. Every time these asset bubbles start to rupture, whether it's stocks, bonds, or corporate debt, the central banks don't tighten policy. They panic. They throw open the monetary spigots. If Powell even tries to stay the course, to be the new Volcker, he'll have a public mob camped outside the Eccles building within 6 months. Remember, most people aren't looking for a sound monetary system. They're looking for their 401ks to keep magically going up. So the minute stocks tank, or the bond market shows real default pricing, there will be blood in the streets, politically speaking. Gold knows this. That's why during every real stock market bear trend of the last century, gold went up. Sure, there were some short-term blips. You might see gold dip for a month or two, along with equities in a liquidity crunch. But in every prolonged bear trend, gold soared. Because the Fed, or the ECB, or the BOJ, always comes running to degrade the money unit. They'll call it accommodation, or policy flexibility. I call it monetary self-immolation. You want an even better opportunity? Look at the miners. Those stocks have been the unloved stepchildren of this market for years. No one wanted them. Everyone wanted Tesla, Nvidia, crypto, you name it. Meanwhile, miners were trading at multi-decade lows on a cash flow basis. Now, they're finally starting to grow a backbone. They're slapping asset managers in the face. Over the next 12 to 24 months, I think you'll see miners double or triple gold's percentage gains. Because once institutions realize that they can't hide in bonds or overpriced tech, they'll look for real cash flow tied to rising metal prices. The miners will offer that leverage.
You didn't. Once you made that high, you collapsed. You never got back to the high again.
Yeah.
I mean, you collapsed the first few months off the high, came back, but you could never get back to the high.
Yeah.
And it was gaseous. It was hardly even a high. The reality up there above the mid 45 level or something, it was temporary. This time we've just come out of congestion, and you'll notice if you draw a line through the lows in 2011 and 12, where silver pulled back to about 25 there, going up, the lows that occurred, right there.
Oh, right. These ones right here?
Yeah, right there.
Okay.
Find the low close in there. Go up a little bit further, the low monthly close in that zone. You'll see a bar there. You go up a little bit further, take that line up, your line up, the red line's there, right up a little bit, take it up. Yeah.
This one?
No, take it down some now. Right about the stop, yeah. Move your solid line up a bit.
Low is 26.10.
No, the close. You'll notice
the close is 27.
Yeah, and if you'll look over to the left, you'll see another close at about 27 something.
27.75.
Yeah, and then even back and further, there's a bunch of closes there. Now, if you go horizontally, look at the recent action. Look where that line intersects. We stopped basically at that upper 20s repeatedly there in the 2021, et cetera. Finally broke through it. So you broke through a price level even that said, hey, man, wake up. You just went through a major pivotal zone. And again, we're not behaving like a blow-off top. We're just emerging from congestion.
Yeah.
Our assumption is over the next, say, 5 months or so, next 2 quarters, you're going to see silver in the 60s to 70s.
Oh, wow.
In this surge.
Yeah.
Now, that's not the top. I'm not arguing that's a top. I'm arguing in this particular surge that is just beginning, I think you could see us well above the old 50 highs, up into the 60, 70 zone before you even pause.
Huh. Okay,
Now,
so
again,
you're kind of thinking we're like here, right? You're thinking like this part of the pattern is kind of like this?
Yeah, and about, if you'll look there at about, half a dozen months, you left the earth. Okay, now then you topped. I don't think that's going to happen this time.
Okay.
I think you're going to, I've got friends and associates that think, you go to $200 wouldn't shock them. And they're fundamentally astute folks. I won't mention their names. You probably know them. I fully agree. But right now I'm just looking at this leg that is beginning to unfold. And I think it's going to blow past that silly high at 50 and the other high back in 1980 at 50.
Yeah.
They're sucker highs. They're ridiculous. In real dollar terms, we'd have to be probably $200 or $300 just to match those highs in a real dollar value.
There's been a lot of printing since then.
Yeah, I think so. So silver's catching up, and I think it's going to vastly outpace gold.
So let's pick up right where we left off, because I want to drive this point home. What we're witnessing right now is the slow collapse of the most reckless debt-driven experiment in financial history. And I'm not being hyperbolic. If anything, I'm probably being too restrained. Look at where we are. The US alone is pushing $35 trillion in official debt. And that's not counting the hundreds of trillions in off-balance sheet liabilities, entitlements, and unfunded promises that politicians keep writing like they're candygrams. Meanwhile, the Fed's balance sheet, after supposedly normalizing for a couple of years, is still hovering near $8 trillion. That's more than double where it was just a handful of years ago. And we're supposed to believe this is all under control? Here's a little laugh from the Twitter sphere, or X if you want to be modern about it. Someone posted the other day, "At dollars last, the Fed has a plan to gently bring the economy in for a soft landing. Me, like the Hindenburg did. Inflation, Rotsteck gold." It's dark humor, but painfully accurate. Because you don't get to inflate your way out of 50 years of serial bubble creation without paying the piper. And the piper, in this case, is the purchasing power of your money. Now let me talk a bit about silver, because silver's setup right now is frankly outrageous. Earlier, we discussed how it's been chewing through that resistance zone from the old 27 to 28 range. That was a monster ceiling for years. Well, now we're floating solidly above it, consolidating in the high 30s. And this is where people get it twisted. They think, oh, it's run too far, too fast. Maybe I'll wait for a pullback. Newsflash, markets don't politely wait for you to get comfortable. They exist to frustrate the maximum number of people at all times. And technically, what silver's done is not the mark of a blow-off. A real blow-off is like 2011. Vertical, unsustainable, emotion-driven. This is different. We're emerging from more than a decade-long base. That kind of structure usually precedes a multi-year secular move. I often tell people, go back and look at commodity supercycles. They don't last 6 months or a year. They tend to run for 5 to 7 years once they break out. And silver hasn't even gotten close to reflecting the monetary and systemic risks baked into this environment. Not even close. Look at what happened back in the 1970s. Everyone likes to point to the Hunt brothers cornering the market, driving silver to $50. But that was just the final acceleration. The real story was the macro environment. The US was drowning in deficits from the Vietnam War and the Great Society spending. Nixon cut the dollar's last ties to gold in 1971. The dollar tanked, inflation soared, and gold and silver responded exactly the way they're programmed to, by skyrocketing. Sound familiar? Except now it's all on steroids. The deficits are bigger. The debt loads are planetary. The monetary base has ballooned beyond any historical precedent. And instead of being confined to the US, this is a global story. Everyone's been running the same monetary playbook. Meanwhile, if you want a chart to tattoo on your forehead, okay, maybe not literally, your spouse would probably kill you. Look at the gold-silver ratio. It's still hovering north of 80. Historically, anytime you've been north of 80, it's been a generational opportunity to favor silver. In past cycles, that ratio has collapsed down to 40 or even 30. If gold is at $3,000 and we drop to a 40 ratio, that implies silver at $75. If we go to 30, you're talking 100 silver. And that's just to normalize the historical relationship. And I'll say it again because it bears repeating. That's not even accounting for the fact that in inflation-adjusted terms, silver would need to be $250 just to equal its 1980 high. That's how much the dollar has been degraded. Now let's have a little aside about the psychology of this whole thing, because it's always psychology in the end. Fundamentals and technicals are great, but markets are ruled by fear and greed. Right now, we're still in what I call the smug phase. People think their tech stocks will keep going up forever. They think AI is going to solve everything. And hey, maybe one day it'll replace us all, and we won't have to worry about retirement, right? Meanwhile, most folks see gold and silver as relics, the things your crazy uncle keeps buried in his backyard. But let me tell you, sentiment changes fast. When the Nasdaq cracks, when the bond market starts sending up real default signals, when rates stay sticky high and the corporate zombies start keeling over, people will stampede for the exits in the things they thought were safe. They'll look for hard assets, and they'll realize belatedly that there isn't enough gold or silver to go around. Not at these prices. Remember how I mentioned earlier that we onboarded 4 years' worth of new clients in 6 weeks during the mini bank panic? That's the tip of the iceberg. Wait until it's not just a couple of tech-focused banks going under, but systemic failures tied to trillions in commercial real estate, zombie corporations that can't roll their debt, and sovereigns choking on their own bonds. Then you'll see the real panic. And let's throw in another little cherry on top. Central banks themselves are already front-running the public. They're buying gold hand over fist. China's been accumulating for years under the radar, with numbers 10 times bigger than they report. That's not my guess. Goldman Sachs finally admitted it in print this year, after some of us have been shouting it for 2 decades. Why are central banks doing this? Because they know exactly how this story ends. They're the ultimate insiders in the fiat system, and they're quietly hedging their bets. And sure, it gets 1,000 likes from people who've never lived through a proper credit unwind. But you know what you can't do with Bitcoin? You can't redeem it to pay your taxes in most countries. You can't walk into a local store and buy bread with it when systems are locked. You can't anchor a national currency on it. And if the power grid fails, or your exchange goes bust, good luck. Meanwhile, gold has been trusted as a store of value for literally 5,000 years. It's been money everywhere from the Roman Empire to Mughal India to modern Switzerland. When things break, societies don't look for the new experiment. They run back to what has always worked. Now people ask me, Mike, what about the miners? Is it too late? And I say absolutely not. In fact, if gold goes from $3,000 to $5,000 in the next few years, which is entirely realistic given the scale of the monetary distortions we're talking about, miners could easily 3x, 5x, even 10x, because their costs are relatively fixed. As the metal prices rise, their margins explode. That's why in the 1970s, mining stocks didn't just match gold. They outpaced it by a factor of several times. There's an old saying on Wall Street, gold is the insurance, miners are the lottery ticket. You want both. You hold physical gold and silver as your core reserve, your ballast in the storm, and then you overlay miners for torque. But if you try to just play miners without holding the underlying metal, you're basically speculating on the most volatile piece of the chain. It's like betting on high-octane options without owning the stable asset. Don't skip steps. So what do we watch for next? Well, I'll give you my technical lens. Silver pushing decisively above the mid-40s will be the first real confirmation that we're headed into a vertical phase. Once that happens, there's very little historical resistance up to $70. And frankly, after that, the sky's the limit. Meanwhile, watch the gold-silver ratio. If it starts plunging, you know silver's on a tear. Watch long-dated treasury yields. If the 30-year refuses to come down, even as the Fed tries to ease, that's the market screaming it's lost confidence in the Fed's ability to protect the dollar's purchasing power. That's your green light for even more aggressive precious metals positioning. And here's where it gets existential. You see, all of this, the commodity moves, the bond volatility, the mining breakouts, they're not just about profit. They're about surviving the kind of monetary transition that only happens once every few generations. Because when this system fully loses credibility, there will be an international rush to reset, and that will almost certainly involve gold. Whether it's through BRICS launching some gold-linked trade currency, or the US being forced under the next administration to offer gold-backed long bonds to entice foreign buyers back to the table, gold will have a starring role. Judy Shelton, who I've spoken with many times, is already floating the idea. And Trump's team has repeatedly hinted they'd look at pegging long-term treasuries to gold. That's not conspiracy theory. That's a serious proposal by serious people. Because they see what we see. The treasury market has lost its luster. The buyers are drying up. The only way to restore confidence may be to anchor it in something real again. And that brings me full circle. Why do I sound so adamant? Why do I pound the table on this every time I get on a podcast or in front of a room of investors? Because I don't want you to be the person left standing when the music stops. I don't want you chasing gold at $6,000 or silver at $120 because you finally saw it on CNBC. I want you positioned now, when they're still calm, when mints can still deliver product, when miners are still undervalued. Because one day, probably sooner than most realize, that window closes. The float dries up. The premiums spike. You'll hear your buddy complain he can't get delivery on an order for weeks. Or he's stuck buying at a 30% markup. That's how these transitions always unfold. Slowly, then all at once. So do yourself a favor. Study history. Look at the Roman denarius. Look at the Weimar mark. Look at the Argentine peso. Currencies come and go, but gold and silver are forever. And if you can position a slice of your portfolio there now, you're not just buying upside. You're buying insurance against the single biggest financial storm any of us are likely to see in our lifetimes. I'll leave you with this. Someone sent me a meme last week. It was perfect. Picture of Jerome Powell with the caption, "Trust me, bro, it's just transitory." Below it was gold, winking. And that, my friends, says it all. Stay sharp out there. And remember, markets may bounce, politicians may bluster, but gold doesn't care. It simply reveals the truth.